Good afternoon. Today I have a presentation. Okay, this is kind of inspired by how I've gotten away from trading retail traps because I know the retail traps are a real thing. Retail setups, everything, all the playbooks, all the cheat sheets that are out there, they do not work. And for every single new trader, they over leverage, over margin, risk a lot of money, thinking these retail traps, these retail. I'm just resort to calling them traps now. These retail things are an effective way of trading. So I want to create a series where we can go through and identify these retail setups and when they actually work, and then define them statistically using probability. So this is titled The Variability of the Engulfing Candle, the Probabilities Study. Okay, of all the trademarked, repeatedly touted market structures that retail traders engage in, the engulfing pattern is arguably the most used. The origins of engulfing patterns are not entirely known. However, given the repeated mentioning and constant inclusion in every beginner and intermediate pattern cheat sheet, it is probably the most common. This study is structured to test the validity of the engulfing pattern and all of its presentations and to compile the data using statistical significance. The rules of this study are as follows. The pattern must be present with a preceding bar that is primarily full with little wick shown on either side. The trigger bar must be a fully engulfing candle that has closed, also with very little wick. Tests will not be performed on an engulfing pair if a trade is currently ongoing, meaning if we're in a trade waiting for it to work, we will not enter another trade in the other direction if it presents itself. We will hold the trade until it is a win or a loss. All trades will have a mean target of a 1-to-1. I will look for a 2-to-1. 100 tests will be formed with an average efficacy. Of the 100 tests, we will also measure a 1.5-to-1 and a 2-to-1 and losses. Losses will be given a grade with the criteria. Was the loss against market direction, with it, or low volume, high volume? Tests will all take place using 5-minute candles. Stops will include the entire body of both the trigger bar and the preliminary bar. So, after 100 tests, data across 100 trades resulted in a 70% win rate. This is actually quite good. Of these trades, all were graded with the following acronyms: AT, CT, or EXT, for against the trend, with the trend, or an extension. If trades were taken short after a large buy extension, betting that the market was going to reverse, these losses would be marked as an extension trade. So a mean reversion. It's run aggressively up, and now we're looking for that short signal. We're shorting it. If we take a loss there, it will be lost and marked as an extension loss. Okay. Against the trend, or AT trades, are categorized by an entry in a low or high volume time period where there were at least 2 consecutive higher lows and higher highs if the trade was a short position loss. So if a trend has suddenly been established, it's gone high, pulled back, gone high, pulled back, it's now in an uptrend. Trading against the trend, if a loss is taken, it would be recorded as an against the trend, or AT trade. If the trade was a short position, a loss is taken while trading with the trend were marked CT. Results found were that given a risk of $100, 30% of trades were losses, resulting in a net negative $3,000. 30% of trades were $100 wins, or 1-to-1 wins, resulting in a net $3,000 profit. So break even. 40% of trades were 2-to-1 wins, or resulting in $200 wins, resulting in $8,000 net profit after everything was said and done. Okay, resulting financial standing was a net P&L increase of $8,000, or given the account was a $50,000 account, a net increase of 16%. 82% of the losses were taken when trading against a current trend. Of the AT losses, 62% of the losses were in high volume time periods marked by bars that were on average twice the length of low volume bars. For instance, the lower volume bars are quite small. Okay, 3 to 5 pips, 30 to 50 points, high volume 6 to 10. Okay, 8% of the losses incurred were taken during a counter trend entry after a market extension. Okay, so we've extended, we get a bearish engulfing, and now we're going down. Okay, we had 8% of our losses, ended up being 2 total losses. After a market extension, betting the market was losing buy or sell volume after a large directional move. The following trades taken during this extension period were almost always winners as the move became a new trend. So what this information here means is that of the majority of our losses, 82% of the losses were taken in high volume periods against the trend. So we would want to eliminate those. 8% of our losses were taken in counter trend trading after an extension. And although they were the losses, we also had quite a bit of wins trading that. Okay, so it did end up turning into a new trend in trading that. So that is something we want to keep doing. We still want to continue looking for extension reversions to the mean, okay? Betting the market was losing buy or sell volume with a large direction move. Extension period were almost always winners as the move became a new trend. Okay, wins taken during these times were also categorized as CT. Losses. 8% of losses were taken when a following trend. Okay, so with the trend. In the medical terminology, in the medical field, a C with a hash over it means with, because I'm in the medical field. I've been in the medical field for a long time. I was just marked it as C. Okay, so trading with the trend. Okay, it's gone up, pull back, gone up, pull back, gone up. We have an indication to go long. We take that long, and we go up. The 8% of losses that we took were when we were deep into the trend. We had a bullish engulfing, and there was no significant pullback yet. Those were where the continuation trends or trading with the trend losses incurred. So if you want to avoid losses, trading a bullish engulfing on a bullish move, on a bullish trend, I would say wait for a decent pullback instead of trading it up during an extensive period, right? Because then the market could easily reverse. So markedly when a trend was already quite established, it already ran hard in one direction, had a slight pullback, and then printed an engulfing pattern. That is when we were taking the losses. Okay, so in conclusion, the closing statements. Given the 70% win rate and 40% win rate of a 2-1, and taking into account that the majority of losses taken were taken when trading against an established trend. If we were to solely target 2-1 trades and eliminate counter trend entries, it is plausible that the overall P&L increase could remain above 16% indefinitely per 100 trades. Since the majority of losses were trades taken against a trend during high volume periods, against trend trades should be eliminated, especially in high volume periods. Okay, so let's get into the charts and I will show you exactly what I am talking about. Okay, so let's get into the last little bit of the trades. So this is how I'm classifying these trades, all right? So on a 5-minute, this was the short entry on this loss, okay? Preceding this, we were in a low volume range, okay? We took a low volume trade, okay, out of this, and this was a win. This is a win, okay? This as well was a win. This as well was a win. This as well was a win. So all of these are wins. But you can see what the criteria is. We're putting the stop behind the pivot of the entry. At a close, we enter, stop, pivot, 1-to-1. Okay? If we had gone for a 2-to-1, we would have lost this trade, and this trade. We would have only gotten the 1-to-1s. Okay? But because in the data it says that 40% of the trades are good for a 2-to-1, and that was the majority, if not all, of the profit we took, it behooves you to hold these for a 2-to-1, regardless of taking any stop or letting it hit your stop. So here we go into extension. Okay, on a trend, okay, we have this pullback and we have no engulfing here. This is not a bearish engulfing because it doesn't close below this previous green bar. This is not a bullish engulfing because the preceding bar is not a red solid bar. Red solid bar, green solid bar. Bullish engulfing, we have an entry here, stop below. Okay, was it good for a 2-to-1? Yes, it was. Okay, again, here we have this because it's such a strong bar, you may want to just get into this trade before it closes, but on the close here, stop, target, was it good for a 2-to-1? Yeah, just about, right? You may not have gotten ticked out because of the spread, but it was good for a 2-1. Okay, so now we're out of that. Do we see any bullish engulfing? No. The red is bigger than the green, and there are too many wicks here. Okay, no bearish engulfing. The preceding candle is a wick candle. It's also red. Okay, and now here we have a bearish engulfing candle. A decently solid green candle followed by an engulfing red body candle with very little wick. Okay, there's a bit of a wick on this end, but you can still take that. Okay, and this would be considered potentially an extension entry because we have gone aggressively in one direction and now we have an idea that the trend may be turning around. Now, is this good for a 2-1? Absolutely it is. Okay, this, even though this is an incredible setup, right? The bull bar did not close above this. This is not a bullish engulfing, so this would not be counted as a trade and we would not take this trade. Okay, here we took a couple of losses. All right, so what are we looking for here? This is not a bearish engulfing. Although this is a reversal signal, this is not an engulfing red candle, okay? Red, green, green, no engulfing, no engulfing. And here we have, as this pushes up, we get a very beautiful bearish engulfing candle, right? Stop above the high of the green candle here for at least a 2-1, right? That was a loss. Okay, same situation, green bar, red bar. Could get in on the close, and it was also a loss. Okay, green bar, red bar, green bar. This is a bullish engulfing. However, if you have slippage, if it's not slippage, if you have a decent spread, or you're trading a pair that has a spread of 10, something like this is going to stop you out. Okay, and that's going to happen. I would recommend maybe having a stop a little bit lower. Okay, a little bit lower, but not by much because you don't want to throw off the data. Okay, however, this did work out. It was good for a 2-1. Okay, this one, all right, green bar, small volume. This is an extension. We've been running up, running up, running up, running up. It's tired. It's ready to go back down, right? Okay, this did not work out. This is our extension loss, the last extension loss. Here, this was good for a 2-1. Okay, here, again, this was also good for a 2-1. Here, decent bar, bullish engulfing close, a lot of wick on this. You could potentially take this, but this is not a key setup for a engulfing, right? Because although we do have a big print red and a small print, this isn't technically an engulfing pattern. However, I did take the trade because of this candle before, okay? And if you draw this out going for that 2-1, I don't think we would have gotten it, all right? If that was the high, yeah, it would have been just shy. Okay, next one, right? This is an extension loss again. Did not get that 2-1. And then we come up, green bar, red bar, green bar. That is a bullish engulfing, and you could take that high. Okay. However, if we had traded here, we would have been stopped out on this candle. Maybe 10 minutes later, we would have been, okay, we get in this trade. Immediately get stopped out. It prints a red bar. This is a beautiful bearish engulfing. We get in short and take it for a 2-1. That works out beautifully. Okay. Now, if we were to just go for a 1-1 on this trade and we got out here and saw this bullish engulfing, okay, this is against the strategy. This is not what we're supposed to be doing, right? You should not flip the script as soon as you get out if that trade is a win. If that trade is a loss, it's okay to flip the script. Here's what I mean. Red bar, short. Comes up, green bar, stops you out. It's okay to go long here. Okay, this trend may, in fact, be continuing higher. It's okay to go long here. Okay, get stopped out red, it's okay to go short here. Okay, but if you get out of a trade and it's going in your favor and then prints a green bar, don't take the trend back up. Okay, if this is a trend that's starting to develop, you don't want to step in the way of it. All right, so if you have a good win, don't turn around immediately and trade counter trend. However, if you're taking a trade counter trend and it shows you that it is going to continue higher, you can be discretionary at this point and take it long. Okay, if you get stopped out and it is looking like an exhausted trade, it is okay to go short, right? Take that second and third attempt, right? Here again, low volume. You can see the difference in the bars. It's very shallow bar, okay? Was it good for a 2-to-1? Yes. Right? Would we have gotten stopped out by slippage? Maybe. Okay. Got to be careful with slippage. So you don't want to trade a pair that's got a wide spread. Okay. We get out for this win at our 2-to-1. And here again is another bearish engulfing. This also good for a 2-to-1. And this continues and continues and continues. This is a beautiful engulfing, but this did not close above, so we would not take that trade. Okay. Here we get this nice candle, and we get this as well. We could potentially take this trade, but this is a pretty big wick. Okay, red bar, no engulfing. Red bar, green bar, but no engulfing. Okay, red bar, green bar, this is engulfing. Okay, a big primarily body candles. Okay, was this good for a 2-to-1? Yes, it was. It would have continued higher, right? Let's say we went for that 1-to-1 only, and then we flipped the script and we took this short, we would have lost that trade. Okay, so that's why I'm saying if it went in your favor, especially if it went in your favor quick, you don't want to suddenly flip around and go, okay, I took it up for 50 points, now I'm going to take it down for 50 points. Don't do that. Okay. If you lose, you go, okay, well, I lost 50 points. Maybe I can make 100 going down the other direction. Right? This would have been a loss if you did that. However, right, if you had waited for a good signal, no engulfing, no engulfing, no engulfing. This is an engulfing pattern. Right? There is some wick, but mainly bodied candles. We go short. Was it good for a 2-to-1? Yes, it was. Okay, engulfing, no. Double wicks here, no. Okay, solid body, solid red body. Was good for a 2-to-1? Yes, it was. Okay, and if you missed that one, look at this. Came back in. Green, red, green, no break, and then the red broke below. So sellers are, in this case, winning. Entry, stop. Was it good for 2-to-1? It was. Okay. Now, again, here we are. We're stepping in front of the trend. Stepping in front of the trend, right? We had 2 wins going to the short side, and now we don't want to flip the script. So this is against the trend loss, right? Beautiful bullish engulfing, immediately loses. Okay. Now, bearish engulfing. Is it good for a 2-to-1? No. Okay. It ends up printing a really great bull bar. If you were to get into this one, it would have been good for a 2-to-1. Okay. And as this aggressively moves, if you were going for the 1-to-1s, you would have closed out here, taken this short, and lost. Okay, so we're holding the 2-to-1s. Again, 2-to-1, was it good for it? Yes. Am I going to take a short immediately after I get out of this winning trade? No. Okay, no engulfing, no engulfing, no engulfing, no engulfing, no engulfing. None, nothing. Nothing. Okay, this is technically, no, didn't engulf. Cannot take that, right? Because this red bar is not bigger than this green bar, so we do not take it. However, green bar, red bar, close below, we take it. Is it good for a 2-to-1? Yes, it is. You see how easy this is. So the strategy is actually very, very, very good. I wouldn't bet the barn on it and make up my own strategy, but does it give you confluence? Can you trade this as a strategy and consistently make money? If you follow the strategy exactly the way that I have performed it today, using the same criteria, okay, in this APA paper presentation, you can make money using a bullish engulfing candle structure entry. Okay, guys? All right, thank you very much for tuning in and watching this video. If you guys have any recommendations, let me know. I'll keep putting out content bi-weekly. Instructional videos, and I'm going to make a segment now where I go over these retail trades that are taught to all of us traders, that retail pattern cheat sheet. And the next video I'm going to do is going to be on flag patterns and why they are my least favorite thing to trade. Okay, until next time, guys, thank you very much for tuning in. Please like and subscribe, and I'll see you next time.